Welcome to Money and Markets Series 5, Lesson 5. We have covered equities, currencies, and exchange-traded funds. This lesson turns to something older and more tangible than any of them. Commodities: wheat, oil, copper, gold. The raw materials that everything else is built from. And futures, the contracts that let producers and buyers lock in a price today for delivery in the future. Futures markets were invented to solve a real problem: uncertainty. A farmer does not know what wheat will cost at harvest. A refinery does not know where oil will be in 6 months. This lesson is about how futures solve that problem and the risks they introduce. It is January. You own a bakery. Flour is your biggest cost. You need to buy 30,000 pounds of wheat in July, when your summer orders peak. Today, wheat costs $350 per ton. That is a number you can build a business plan around. But what will wheat cost in July? A drought could push it to $600. A bumper harvest could drop it to $250. For you, the uncertainty is the problem. You are not a wheat speculator. You are a baker. 600 years ago, merchants in Amsterdam and Osaka invented a solution. The futures contract, a binding agreement to buy or sell a fixed quantity of a commodity at a fixed price on a fixed future date. Today, futures markets handle everything from oil to orange juice. Commodities fall into two broad families. Hard commodities are mined or extracted: crude oil, natural gas, gold, copper, aluminum. Soft commodities are grown: wheat, corn, soybeans, sugar, coffee, cotton. What makes something a commodity in the financial sense is interchangeability. A barrel of West Texas Intermediate crude from Texas is treated as identical to a barrel from Oklahoma. A bushel of Grade 2 hard red winter wheat from Kansas is the same as one from Nebraska. This interchangeability is what makes commodity markets work. It allows strangers who have never met to agree on a price, deliver a product, and trust that what arrives matches what was promised. The spot price is what you pay to receive a commodity now in the physical market. The futures price is what you agree today to pay or receive for a fixed quantity at a future date. Say crude oil trades at $80 per barrel today. That is the spot price. The December futures contract might be priced at $82. The market is willing to commit to $82 for December delivery. Or the December contract might be at $78. That would mean futures are below spot. The relationship between spot and futures prices is not random. It follows a logic called the cost of carry. Why do futures prices differ from spot prices? Because holding a commodity costs money. If you buy oil today and store it for 6 months, you pay for the oil itself, the financing cost of tying up cash, storage, and insurance. In exchange, you might earn a convenience yield, the value of actually having the physical commodity on hand when you need it urgently. The formula: futures price equals spot price, multiplied by 1 plus storage costs plus financing costs, minus convenience yield, raised to the holding period. When storage and financing dominate, futures trade above spot. That is Contango. When the convenience yield is high because supply is tight right now, futures trade below spot. That is backwardation. In normal times, oil futures trade in Contango. The December contract is more expensive than the spot price. The March contract is more expensive than December. The futures curve slopes upward. Why? Oil is cheap and plentiful right now. There is no urgency to hold it. The market prices in storage costs, and futures are higher than spot. The most extreme contango in history happened in April 2020. COVID lockdowns had destroyed demand. Storage was nearly full. The May futures contract for West Texas Intermediate crude oil briefly traded at -$40 per barrel. Negative. You were paid to take oil off someone's hands because there was nowhere left to put it. Backwardation is the opposite. Futures price below spot. The curve slopes downward. This happens when something is scarce right now but expected to normalize. Think of wheat after a drought. The current harvest is poor. Buyers need wheat today, so the spot price is high. But the next harvest is expected to be better. So futures for delivery in 6 months are cheaper than today's spot price. The market is saying the current shortage is temporary. Another example, energy crises. When natural gas storage falls dangerously low before a cold winter, spot prices spike. The curve inverts into backwardation because the market expects supply to recover once the season passes. Backwardation signals current scarcity. Contango signals current abundance. Futures markets work because two very different groups of people need them for opposite reasons. Hedgers want to remove price risk. The baker from our opening story. The airline that knows it needs jet fuel in 6 months. The copper miner who wants to lock in a sale price before the mine starts production. They enter the futures market not to profit from price movements, but to eliminate the uncertainty that would otherwise make planning impossible. Speculators want price exposure. They have no use for actual barrels of oil or bushels of wheat. They are betting on direction. Their presence makes the market liquid enough for hedgers to find counterparties. Futures markets work precisely because these two groups need each other. Hedgers want to offload risk. Speculators want to buy it. Here is a trap that catches many commodity investors. Say you believe oil prices will rise. You buy a crude oil ETF, but the ETF does not hold physical oil. It holds futures contracts, and futures contracts expire. Every month, the ETF must sell the expiring contract and buy the next one. This is called rolling. In Contango, the next month contract is more expensive than the current one. Every roll means buying high and selling relatively low. This continuous drag is called negative roll yield. Even if oil prices stay flat, the ETF loses value each month from rolling into more expensive contracts. In a steep contango, commodity ETFs can lose several % per year just from the roll, before any actual price movement. This is why commodity ETFs often disappoint investors who understand prices but not futures mechanics. Commodity futures let buyers and sellers agree today on a price for future delivery. The futures market solves the planning problem. Spot price is today's price. Futures price reflects spot plus the cost of carry. Storage, financing minus convenience yield. Contango means futures above spot. Abundant supply, storage costs dominate. Backwardation means futures below spot. Scarce supply, holders prize immediate possession. Hedgers remove uncertainty. Speculators seek it. Together they create liquid markets. Roll yield is the hidden cost of owning commodity futures through ETFs. In Contango, it consistently erodes returns. In the next lesson, we meet the most flexible financial instrument ever invented. Options. The right but never the obligation to trade at a fixed price.